Hello everyone, I am Sia Anshubudia and I'm back yet again to discuss the tax changes that is applicable on account of Finance Act 2024 and applicable for the tax year 24-25 that is relevant for your exam terms June 25 onwards. Hence, let's look at these tax changes one by one, understanding them with examples. So I'll just share the screen and we discuss them. The first tax change that I'm going to discuss is the nil rate band changes while calculating the dividend income. Earlier, the nil rate band for dividend income was 1000, but now this tax year it has been reduced to 500. What does it mean? It means that up to GBP 500, 0% would be the tax applicable to any taxpayer for their dividend income. And for the dividend income earned beyond £500, then depending upon the rate bands, the tax rates would apply for dividend. The dividend tax rates have not changed as compared to the previous tax years. That would mean that if the taxpayer's income beyond 500 is in the basic rate band, the tax rate applicable would be 8.75%. When it goes to a higher rate band, then the tax rate applicable is 33.75%. And in the additional rate band, the tax rate would be 39.35%. I hope you're clear with your first tax change. Next is the change in child benefit charge calculations. So, what is the new change? Let's have a discussion about it. Where income is between pound 60,000 to pound 80,000, the limits have enhanced. The charge is 1% of the amount of child benefit received for every 200 of the income over 60,000. Yes, there is a major change in this. So let's have a question to understand this better. I have taken a question here which is simple to understand the child benefit charge. Here is a question. Samantha is divorced and has two children aged 10 and 6. She has net income of 67,500 in 24-25. Samantha made personal pension contributions of pound 4500 gross during 24-25. She receives child benefit of 1828 in 24-25. Calculate Samantha's child benefit income tax charge for tax year 24-25. So, for calculating the child benefit tax charge, our beginning point is adjusted net income. How do we calculate adjusted net income? Formula is not changed, friends. It is still the same, which is net income less gross personal pension contributions and gross gift aid donations. This question specifies gross personal pension contributions. Hence, from net income of 67,500, we would reduce 4,500 gross personal pension contributions to arrive at the adjusted income of net income of 63,000. Now, please see if this is above pound 60,000. Yes, that means child benefit charge would apply. So, what is the excess? 63,000 less 60,000, which is 3,000. Now, we will take this difference for every 200. That means you divide it by 200. We get 15, which is simply reflecting 15% of the child benefit received would be taxable or would be subject to child benefit charge. So, what is the child benefit charge? 15% of 1828, which is a child benefit received for 24-25, which is 274. So, the child benefit charge to be added to the income tax liability would be 274 for the tax year 24-25. I hope you are done with this change as well. Third, now we go to the pensions chapter and there let's understand the multiple changes that have taken place. First, the annual allowances have enhanced from 40,000 a tax year to 60,000. But there have been other changes also. So let's look at it in detail. Annual allowances for 21-22 to 22-23, for these two tax years, the annual allowances are not enhanced and they are at 40,000. But with effect from tax year 23-24, the annual allowances limit have increased from 40 to 60K. Minimum allowances have also been raised from 4,000 to 10,000. And income limits have also been raised to 2,60,000 in order to calculate the tapering. That means when the adjusted income exceeds 2,60,000, then yes, tapering of AA will take place. Let's understand this better with an example. And adding on to it, I have given the tapering details also here. That means individuals who have adjusted income going beyond 2,60,000 will have a reduced AA. But reduced annual allowances will also not go below 10,000. Minimum 10,000 would be available for the tax year to the taxpayer. Adjusted income, I'm sure you're able to recollect. It is net income plus employees' contribution to the pension schemes, and that is the occupational pension scheme, and employer contribution to the occupational pension scheme. Let's look at a question to understand this better. Peter is a member of a partnership and his share of the trading income is 2,65,000 in the tax year 24-25. During the tax year, Peter paid interest of 12,500 on a loan to invest in the partnership. Peter's wife, Catherine, is employed by Peter's partnership. That means she's an employee. She's paid an annual salary of 3,40,000 in the tax year 24-25. She pays a 10% of her salary into her employer's occupational pension scheme. That means employee's contribution is 10% of the salary, and the employer contributes further 5% of the salary. Catherine also made a gross contribution to a personal pension scheme for 10,000. The couple jointly owns an investment property which is let out to the tenants and has generated profits of 67,000 in the tax year 24-25. The question says, what is Catherine's annual allowance for the tax year 24-25? So for that we need adjusted income, right? So first let's have net income. Net income would be the employment income, which is 3,40,000 less an allowable deduction. What is an allowable deduction? Employees' contribution. Employees' contribution to the scheme is 10% of the salary. So, which would mean that when we take the employment income, I'll take 3,40,000 and I'll reduce 10% of it, because employees' contribution is an allowable deduction while we calculate employment income. Then we get 3,06,000. Now there is a share of investment property also because it is jointly owned. Unless the percentage is specified, we will take 50-50%, which here would be the case. So the profits are 67,000. Half of it is 33,500. That would also generate to Catherine. Now we add it and we get net income of 339,500. With this, we add employers' contribution and employees' contribution. Okay. Employees' contribution is 34,000. Employers' contribution is 3,40,000 multiplied by 5%. When you add it, you get a total of 51,000. This would be added with the net income to get adjusted income, which is here 3,90,500. Now, what is the AA reduced to? Because, of course, this adjusted net income is going beyond 2,60,000. So step 1, take the excess over 2,60,000. 3,90,500 less 2,60,000, we get 1,30,500. Now we will take this. This is subject to the annual allowance of 60,000 is the limit that we have. Correct? Now you will take 1 by 2 of the excess. 1 by 2 of the excess is 65,250. So what do you find? When you take this, you find that 5250 is what is the available annual allowance. But we know that this cannot go below 10,000. Hence, annual allowance available for the tax year for Catherine is 10,000. So if you look at the options, 10,000, that is B option, is the correct answer. I hope I've absolutely made it clear about how to calculate the tapering of AA when you have these enhanced allowances, and the limit has also increased for calculating the tapering. Next, let's move on and let's understand a typical small theory change that has come into your syllabus, which is relating to lifetime allowances. Earlier, we had a capping of lifetime allowance as a limit, which was also part of your tax rates and allowances chart. But now there are changes that have taken place. Now, due to which the change that has taken place in Finance Act 2024, lifetime allowance limits have been abolished. This is meaning to say that now maximum tax free lump sum amounts that can be withdrawn is also changed, but that is not applicable for your exams. So then, if a question comes in for lump sum, you will still apply the old rules. That is, maximum 25% can be withdrawn as lump sum after the age of 55, that is a retirement age. And the remaining amount can be taken as regular taxable income to be taxed at the applicable rates to the taxpayer. I hope I made it all very clear. Now, the remaining changes will be discussed in the next lecture. Thank you. See you soon.